Ladies and gentlemen. This is Leonard Spoto, and I'm going to be the host today for our Advanced 1031 Exchange webinar. So I want to take a moment to thank you all for joining today's webinar and spending a little bit, almost an hour of our day together. What we're going to do today is we are going to talk about the 1031 exchange process and get into all of the details about how to successfully complete a 1031 exchange. Now, before we do dive into the details, though, I just want to make a couple of announcements. So first of all, everybody who joins today's webinar is going to receive a copy of all the PowerPoint slides that we're going to go over. So you're going to see about 30 slides or so today. Feel free to make notes if you want to, but we will send you a copy of all the presentation material about an hour or two after the presentation ends. Now, the second thing I do want to say is that if you have questions or comments during the webinar, please do let me know. Now, during a webinar, the way that you ask a question or make a comment is you type it in. And then what happens is your question will pop up on my computer screen, and I will try to answer all of the questions as they are pertinent. Now, some of you might ask questions about a particular topic that we're going to cover at a later point in the presentation, and if so, I'll try to address your question then. So don't think I'm ignoring you if I don't immediately answer your question. I will stay on the call for as long as it takes me to answer all of the questions. So we are scheduled to run our webinar today from 1 o'clock to 2 o'clock. But if it takes me a little bit longer because you guys have a lot of questions, I'll stay on the call for as long as necessary. So thank you all for joining today's webinar. My name is Leonard Spoto, and I am one of the owners of Asset Exchange Company. Now, Asset Exchange Company is a 1031 exchange qualified intermediary. So my company does not sell title insurance. We don't do escrow. The only thing that we do is facilitate 1031 exchanges. So the tax law, as it relates to Section 1031 of the Internal Revenue Code, says that if you are going to defer your capital gains taxes by conducting a 1031 exchange, you need to use a neutral third party to facilitate the process. So that's what we are. We're an accommodator, a facilitator, a qualified intermediary, or just a regular old plain exchange company. We've been called all of those things, and they all mean the same thing. Now, as a 1031 exchange accommodator, we are a neutral third party to the transaction. So again, we're not buying and selling real estate. We're not selling title or escrow services. All we do is facilitate exchanges. And California state law requires that all exchange companies carry proper insurance and are bonded. So my company is in compliant with California state law. We carry the required insurance and we are bonded. Now, my company also is a member of the California Board of Accountancy as well as the state bar through our tax attorney, Adam Skarsgård. So we are one of the few exchange companies that you can work with that actually has a tax attorney on staff handling files. And because we do have that tax attorney on staff and we are such experts at the tax law, this is again all we do provide our clients with audit support should the 1031 exchange ever be challenged by the Franchise Tax Board or the IRS. So one of the things that happens when you do a 1031 exchange, you need to follow the rules. If you don't follow the rules and you get audited, the government's going to disqualify your exchange. Now, not only could the government potentially disqualify the exchange, but they can make you pay penalties, fines, and because we are dealing with tax law, if you are found to be in violation of the tax law, they may throw you in jail for tax fraud or tax evasion. All right, so when you're doing a 1031 exchange, it's very, very important that you follow the law. What we're dealing with is tax law. If you commit tax fraud, that is a criminal offense, and people have been thrown in jail for tax fraud or tax evasion related to 1031 exchanges. People ask me all the time, hey, Leonard, we're doing this 1031 exchange, and we heard there's some gray area in the law. and we heard we can backdate our ID letter, or maybe we can do something else that isn't necessarily kosher. Well, ladies and gentlemen, I do not recommend it. I'm a big fan of my freedom. I do not want to be party to tax fraud, and neither should you. Tax fraud, again, is a criminal offense. There is actually a case that you're looking at right here on your computer screen about a real estate agent named Cheryl Savage, who was sentenced to 14 months in jail for tax fraud related to her 1031 exchange. And let me tell you Cheryl's story. What happened was Cheryl decided to do a 1031 exchange. She sold her property and she deferred a lot, 6 figures, in tax liability. So Cheryl did her 1031 exchange, she deferred her taxes, she went out and bought a new property. But guess what? She moved into that property immediately, and then she falsified her tax returns to make it look like the property that she was living in was a rental. Ladies and gentlemen, that's tax fraud. She got audited, her case wound up in court. Court found her guilty of tax fraud and sentenced her to 14 months in jail. So these tax laws can be fantastic when you do them right, because they're going to allow you to defer and possibly even avoid paying your capital gains taxes. But you need to follow the law. All right? Again, not a lot of flexibility within the code section 1031. You need to follow the law, you need to sell an investment, you need to buy an investment property, you need to get it done on time, and you need to be able to defend your position if you're ever audited. Now, as I mentioned, one of the things that my company does is we're going to facilitate your exchange. If you do get audited by the IRS or the Franchise Tax Board, guess what? Our tax attorney will help you defend that exchange, the position you took in the exchange, at no additional cost. So we're the only company in the industry that provides audit support. And ladies and gentlemen, since 2012, the Franchise Tax Board has been very, very aggressive in auditing 1031 exchanges. In fact, they made it one of their top priorities. So if you go to the Franchise Tax Board website, you'll note that in 2012, literally in writing, they say, hey, 1031 exchanges are one of our top audit priorities. So since 2012, what we've seen is a dramatic increase in the number of clients being audited. So if you're going to do a 1031 exchange, especially if you're going to do a complex or a very large transaction, make sure you follow the rules, because chances are you're going to get audited, and you have to go into every exchange assuming that you're going to get audited. Hopefully you don't, but make the assumption that, especially on complex and large 1031 exchanges, just assume you're going to get audited. Make sure your transaction is clean, and you won't have a problem if you're ever audited by the Franchise Tax Board or the IRS. Now, hopefully I've scared you all into paying attention to this webinar. And before we get into the nitty-gritty of how to make sure you're following the law, let me talk about a couple deals that my company has worked on in the past, because they illustrate some interesting points about the 1031 exchange process. So let's take a look at the first building here, the Galaxy Office Park. Now, this property sold several years ago for $42 million. And what was interesting, when this property sold, the clients who were pretty sophisticated investors came up to me and said, hey, Leonard, we are going to do a 1031 exchange on this property. And when it sells and closes escrow, there's going to be about $30 million of cash coming out of the sale property. Can we, they asked me, can we put that $30 million in our bank account until we find replacement property to purchase? What do you guys think? Can you hold your sale proceeds if you plan on doing an exchange? Can you touch those money? Can you have any control of those sale proceeds if you're going to do an exchange? Well, the answer is no. The government does not allow you, when you're doing a 1031 exchange, to be in constructive receipt of the sale proceeds. What that means is you cannot pledge, borrow, collateralize, or have any influence over those sale proceeds. They need to be held by a neutral third party until you find replacement property. So very, very important. You're going to do a 1031 exchange. You need to get my company involved with the transaction before you close escrow. If you close escrow and the escrow officer cuts you a check for your sale proceeds, you're a taxpayer at that point. Now, I have had people who call my office and they say, hey, Leonard, I closed escrow last week on a property. Escrow officer cut me a check, but I didn't cash it, so can I do an exchange still? Absolutely not. Right? You're in constructive receipt of those sale proceeds. The IRS is going to disqualify that without a blink of the eye. You touch the money, you're a taxpayer. So very, very important, whether you're doing a very large deal or whether it's a modest transaction, you want to get your exchange company involved. That exchange company should be my company, hopefully. But you want to get us involved before you close escrow on the sale property. Can't touch your sale proceeds when you're doing a 1031 exchange. All right, so that's the lesson from the Galaxy Office Park that sold a couple years ago. Let's talk about the next transaction here on the list. This is the Sandy Springs apartment building that sold for $26 million. And the interesting thing about this transaction was that the building itself was owned by 27 individuals. All right, now why is that interesting? Well, you don't really see buildings that are owned by that many people, especially on the smaller level, but on these big deals we see it all the time. And one of the very important things about the exchange process is the fact that the IRS has what we call a same taxpayer requirement. And what that means is the taxpayer who sells the property can be the exchanger, and that same taxpayer has to buy replacement property to complete an exchange. So you have a taxpayer selling, and in exchange, you need that same taxpayer to buy. Now let's take a look at this Sandy Springs building. Well, because of the way that these people held title to the property, there were 27 individual taxpayers on title. And when the property sold, every single one of those individual taxpayers could choose to do an exchange, or they could choose to pay taxes. And the decision was their own. It didn't matter what the other owners were going to do. You could have had 26 people deciding to pay taxes, and one individual could have done their own exchange. That's fine. Because of the way they held title as tenant in common owners, each person was listed on title, and the government knew that there were 27 taxpayers that owned that property. 27 people could do an exchange, 15 could cash out, the remaining 12 could do exchanges. They could have done whatever they wanted to do. Okay, so it's very important that we know who the taxpayers that own the real estate is, right? Imagine if these 27 individuals, they said, well, geez, we would like to, instead of owning the property in our name, we would like to form a corporation, a partnership, or an LLC. And instead of going on title as 27 individuals, what we'll do is we will form an LLC, and that LLC will be the owner of the property. Now, people do this for a variety of different reasons. Number one is to maintain or get some type of liability protection, right? You form a limited liability company, and that LLC will take title and it will provide you an additional level of liability protection. So a lot of our big investors will do that. The problem with an LLC or a partnership or a corporation is that if it is a multi-member LLC, that LLC is going to have its own taxpayer ID number. All right, so again, for 1031 exchange purposes, what we look at is who is the taxpayer who owns the property. Well, if these individuals formed an LLC, those individuals do not own real estate. They own shares of an LLC. The LLC owns the property, and the LLC is its own taxpayer. So for 1031 exchange purposes, I look at the property and I say, well, geez, you've got one seller. It's the LLC. If you would like to do a 1031 exchange, that seller, the LLC, is going to have to go out and buy replacement property. The problem is some of the members within the LLC might not want to go forward. Well, guess what, ladies and gentlemen? That's a problem. That can be a big problem. So it is very important in the 1031 exchange world to know and understand who the owners of the property are. You might have 27 individuals owning real estate, or you might have one LLC, corporation, or partnership. And that is an important distinction to understand because it may affect your 1031 exchange adversely. Now, one of the important things that I do whenever I open a 1031 exchange account is I request a copy of the title report so I have a true record of who the actual owners of the real estate are. Sometimes your clients don't know. Sometimes I speak to clients on the phone and they say, yeah, my brother and I own the property, but then I go and I pull the title report and the brother and the client's name are not on title. There's a corporation. And that affects the exchange because now the corporation is doing the exchange and the corporation has to buy replacement property. So it makes it harder for the individuals to go their separate ways. So very, very important is to understand who our owners and sellers of real estate are. Now, I would love to sit here and tell you that all of the deals that I work on in my office are $42 and $26 million deals, but they're not. The vast majority of real estate that is exchanged throughout the country is typical of this Laguna Niguel property. Now, this Laguna Niguel property was owned as a primary residence by a husband and wife, and about 7 years ago, they moved out and they converted the property into a rental. After about 7 years of renting the property, they said, well, geez, we own this thing free and clear, and we're only producing $2,500 a month in rent. If we sold it and exchanged into something bigger and better, like a 4-unit apartment building, we can probably triple the amount of rent that we get. And that's exactly what they did. So most of the exchanges that we do are at about $1 million or less because that is what is mostly trading throughout the country, right? These big properties, they sell, but not nearly as many big properties sell every day as these little ones. So most 1031 exchangers throughout the country, regardless of where you're at or what exchange company you're talking to, most 1031 exchanges being facilitated across the country are small rental, 2-unit, 4-unit buildings, because that is most of the volume in the real estate market. Now, again, we do handle these very big, complex transactions, right? But you don't see $42 million and $50 million and $100 million buildings selling every single day. But there are a lot of these properties selling and exchanging every single day. Now, again, I want to remind everybody that we do have the opportunity to ask questions. So if you do have a question, go ahead and type it in. Our first question here is from Lan. Lan says, can a single individual member LLC relinquish the property and acquire title as an individual? Okay, so let me rephrase that question for you. So the person who's asking the question wants to know, can an LLC sell a property, and then can the individual buy the replacement property? So again, all I care about is that the taxpayers are the same. So there are some situations where an LLC will have the same taxpayer as the individual. And that happens when you have a single member LLC. All right, so if there's only one member of the LLC doesn't get assigned its own taxpayer ID number. It simply reports taxes as a disregarded entity. There is no taxpayer assigned, no taxpayer ID number assigned to this LLC. The LLC is reporting taxes based on the individual's social security number. So the LLC in this case is disregarded. We don't even look at it for tax purposes. And we see that it's a pass-through or disregarded entity for tax purposes. And the individual is selling and the individual can buy. So good question. Again, that's a little bit more detailed than I usually get into in some of these webinars, but very good question. So what I care about is who the taxpayer is, and in some cases, LLCs can be disregarded for tax purposes. So as long as you remember that, you'll be okay. All right. So ladies and gentlemen, why do clients exchange? Now, you guys are all, or most of you are real estate agents. So you care about this because if you understand why my clients are doing their exchanges, you are going to be in a much better position to service those clients and do deals with them. So here are the reasons why I see clients do exchanges. Number one, they don't want to pay taxes, right? Okay, that's a no-brainer. If you don't exchange, if you cash out, assume about a third or 33% of your gain or your profit is going to go to pay taxes. So people hear that and they say, well, geez, that's $175,000, or that's $250,000 in taxes that I have to pay, right? If clients understand the true tax ramifications of a transaction, they're more likely to consider an exchange. So they're doing exchanges because they don't want to pay those huge tax bills to the government. Okay, that's the number one, that's the main reason. Everybody knows that though, right? You do an exchange because you don't want to pay taxes, right? Obvious, no-brainer. Well, people also do exchanges because they're looking to build wealth in real estate. And the best way to build wealth is not to go out and sell a building and give your money to the government, but it's to keep it in your pocket and use that money to leverage into a bigger and better deal. All right, so you're using the 1031 exchange because you want to build wealth in real estate. Now, some of my clients are already very wealthy, and they own millions of dollars worth of real estate, and they are simply doing exchanges because they need to reposition their portfolio. They want to add some diversification to their portfolio, and diversification does a couple things. It can increase your returns for a given risk, or it can reduce your risk based on a given return. So what we see is our clients are using the 1031 exchange to diversify or reposition their portfolio, and they're going into maybe a different geography, maybe they're going into different types of real estate, or maybe they're doing both. Now, some of you who are real estate agents might think to yourself, well, geez, I know my client Bob pretty well, and Bob owns 15 properties in our small little town. Well, the problem with that is if there's an earthquake in your small little town, Bob might lose all of his real estate holdings. You might want to have a conversation to Bob about getting into a different area, right? If you're in San Francisco and you've got an earthquake and you have $25 million worth of real estate in San Francisco, you might lose all of your wealth. And I have clients who do that. I've got clients who own a ton of real estate in San Francisco, and right now the market's hot. They say, well, geez, let's kind of capitalize on this bull market we're having. Let's get out of San Francisco and get into some place that is less prone to earthquakes. All right, so diversification is key, and it's important to talk to your clients about diversifying their portfolio and doing it tax deferred with the 1031 exchange. Now, last reason that some of my clients are going to do their exchanges has to do with time. And two things happen over time as you own real estate. Number one, you get sick and tired of owning your property. And number two, your property becomes fully depreciated. And both of these reasons are excellent reasons for some of my older investors to do their exchanges. Imagine if you're 85 years old and you own a 10-unit apartment building 4 hours away. Right? Hopefully you got a good property manager, but I bet you're still having to go out and visit that property every once in a while. At 85, that's not so much fun. At 85, you should be spending more time with your grandkids and less time with your tenants. So what do? Well, you transition from your tough to manage property, you exchange out of it and get into an easier to manage property. Or some of my clients, they say, well, geez, I don't mind this apartment building 4 hours away, but the problem is I've owned it for so long that I can't take any more depreciation. Well, time to exchange it? Possibly, right? Some of our clients, their CPA, tell them, geez, as soon as your property is fully depreciated, get rid of it. Go buy a new, larger property that you can take new depreciation schedules on. Right? So I have done thousands of exchanges over the last 15 years, and the reasons why my clients exchange typically fall into one of these categories. So use that knowledge to go have good, thoughtful conversations with your clients about possibly listing their property with you and doing a 1031 exchange. All right, real quick, let's dive into the main reason, the main driver of all exchanges, and that is deferral of taxes. Well, ladies and gentlemen, we pay taxes to the federal government and the state government. The federal government, they charge you a capital gains tax, which is either 15 or 20% depending on your income. The federal government also charges you a tax on the amount of depreciation that you have taken, and that tax rate is 25%. In 2013, the federal government also upped the ante on funding Medicare, and they said, well, geez, we need more money, so we're going to get it on capital gains taxes as well as some other stuff. But for our purposes here, all we care about is that there's a 3.8% tax on our capital gains to help fund Medicare. So ladies and gentlemen, that is the federal tax liability that you can expect if you decide to sell or cash out of your property. Now, that is just one component of the taxes. The other tax that you pay is to the state, and I am in beautiful California, so I'm going to talk about California taxes, which start at about 9.3% and go as high as about 12.3%. And in California, it's all income-based. So the more income you earn, the higher the tax rate. Now, ladies and gentlemen, you don't need to memorize all these tax rates and all the tax equations. All you need to know for our purposes here is that about 33% of your gain goes to pay taxes. Now, let the CPA crunch the numbers to get to the exact tax dollar that you owe, but just for your purposes, assume that 33% of your gain goes to pay taxes. Problem is, a lot of people don't know how to calculate gain, or even if they have gain in their property. Now, some clients that I talk to say, well, geez, Leonard, I sold my property for $1 million. I paid off my debt of $950. So after I pay my commission and my closing costs, I'm not going to have any cash. So if I don't have any cash, I don't have to pay taxes, right? Wrong. Okay, your debt has nothing to do with your ultimate tax liability. In order to figure out how much taxes you're going to owe, we need to know how much gain you have. And gain, ladies and gentlemen, is a function of your sale price minus your adjusted basis. Well, of course, that begs the question, well, do you know what your adjusted basis is? If not, here's how you figure it out. What did you pay for the property? Take that number, subtract out all the depreciation that you've taken, and add back in any capital improvements. That gives you your basis. Now, let's do a quick example here. I went out and bought a building for $500,000. And I've owned it for a while, so I've taken about $100,000 of depreciation. At one point, my roof had a big giant leak, and I had to replace it. That cost me $25,000. And I am now in contract to sell my property for $1 million after commission and closing costs. So, with just that information, I can figure out what my tax bill is going to be. So let's take a look here. First thing we're going to do, figure out our basis. Again, purchase price minus depreciation plus my new roof gives me my basis. I use my basis to figure out that I have a $575,000 gain. I let my CPA crunch all the numbers over here, and it looks like about 33% or 1/3 of my gain goes to pay all these very ugly taxes. I'm going to pause here and let you guys digest the fact that we just sold $1 million property and we're paying almost $200,000 in taxes to the government. That is what we call a bummer. I am not happy writing a check to the government for $192,000. I assume neither of you would be as well, so I'm going to give you some good news. The good news is that because you are selling real estate, you might not have to pay those taxes. The good news is that real estate is the most tax-advantaged investment out there. All right, you have tax breaks when you own real estate. You get to depreciate it. You get to write off your expenses, right? So owning real estate is great because you have tax breaks, but selling real estate is great too because you get a pretty good tax break if and when you sell. And the tax break that you get depends on the type of real estate that you sell. So 2 pieces of tax law here that everybody on this call or everybody who works in real estate should know about. All right? You've got your section 1031 and you've got your section 121. Both of these tax breaks make me very, very happy. Okay, section 121, everybody knows. Section 121 is for the sale of your home, your primary residence. And if you sell a home as a single person, you can avoid paying taxes on the first $250,000 of gain. If you are married, you can avoid paying taxes on the first $500,000 of gain. Right? This is your basic homeowner's exemption. Do not call me if you are selling your primary residence. I can't help you out. Every once in a while, someone calls and said, hey, Leonard, I'm exchanging one house that I live in for another. I need to do an exchange. No, you don't. That is not a 1031 exchange. Okay? When you sell a primary residence, that is a different tax law. All right? You don't need an exchange company. When you need an exchange company is when you decide to sell your investment or business property and defer taxes. All right, you take advantage of section 1031 of the Internal Revenue Code on the sale of an investment or business use property. Section 1031 allows you to defer your tax liability provided you go out and you buy something else. Now, real quick, for those of you who are still awake on the other end of the computer screen, is it better to defer taxes or is it better to avoid paying taxes? Well, in my book, it's always better to avoid, right? Avoiding means I don't have to pay. Deferring means I don't have to pay today. But you're not off the hook. You're just kicking the tax liability down the road. So let me give you an example of what happens a lot of times with investors. I have clients who start off small. They own a 2-unit building and they decide, hey, we've done pretty well with it, but we're going to sell it. We're going to exchange into something bigger and better. So they go and do a 1031 exchange into a 4-unit building. After 5 years of owning that, they go out and sell it and exchange into a 10-unit building. Sell the 10-unit eventually, and over a series of exchanges over maybe 20 years, they get into a nice large 30-unit apartment building. They've done exchanges every single time, so they've never paid their taxes. And now they own this beautiful 30-unit apartment building. The problem is they don't like it. And without consulting me, they go out and sell it. And what happens when you sell and you cash out and you stop exchanging is you're going to pay your taxes on any gain from the 30-unit building and all of the gains from the previous transactions. So what you've done here is you've built a giant snowball of taxes that has gotten bigger and bigger and bigger with every transaction because you've been successful. Right? You've made a big profit on all of these sales, but you've deferred the tax liability on those profits or gain because you've done exchanges. Now that you've stopped exchanging, the government says, hey, wait a minute, show me the money. And in this situation, because you've been so successful, you're going to have to pay $1.2 million in taxes to the government. Ladies and gentlemen, that's a bummer. Now, there are ways to avoid paying that tax. So you own a 30-unit apartment building, don't sell it. Well, I need cash. Well, if you need cash, ladies and gentlemen, there are ways to get cash without paying taxes. You can call up a lender and you can refinance this property. A refi is a non-taxable event that can put cash in your pocket tax-free. So one option is the refinance. Now the other option is if you simply absolutely must get rid of this 30-unit apartment building, go out and exchange it into something else, something that you don't mind managing, maybe a triple net leased Walgreens. All right? So you sell the 30-unit apartment building, you buy a Walgreens or 2 or 3 of them, and you sit back and you just collect your mailbox rent. Now, the other option is what I call the 3 Ds of investing. What I want you to do is I want you to defer, and then I want you to die. I want you to own your real estate until you kick the bucket. So you own a 30-unit apartment building. If you sell it, you face a $1.2 million tax bill. So here's what I want you to do. Don't sell it. Just wait until you croak. Then it won't be a problem for you because you're dead. And guess what happens when you die? Ladies and gentlemen, when you die, the basis in your property steps up to fair market value. So your heirs are going to benefit from a step up in basis. And what happens is they sell the property the day after your funeral and they avoid paying any capital gains tax liability. Well, how does that work? Well, geez, the basis in the property for you was $1 million. But when you died, the fair market value of the property was $5 million. So guess what? Your basis of $1 million steps up to fair market value for your kids or your heirs. It doesn't have to be your kids. You can nominate me as your heir, and when you croak, when you pass away, I'm going to receive that step up in basis. If my basis in the property is $5 million, and the day after your funeral I sell that property for $5 million, I have 0 capital gains tax. I put all that cash in my pocket tax-free. I am a very happy man. So, ladies and gentlemen, there's some strategies where you can turn your 1031 exchange tax deferral into complete tax avoidance. It just simply requires the 3 Ds of investing, or the swap till you drop method. You just keep exchanging until you pass away. Now, someone asked about the inheritance tax, and that is a very good question. But guess what, ladies and gentlemen? The inheritance tax only kicks in if your heirs receive over $5.4 million worth of an asset. So 99% of our clients are going to leave less than that to their kids. So 99% of our clients are not going to have to worry about any inheritance tax. And if done correctly, they're not going to pay any capital gains taxes. That is what I call a win-win. All right, so 2 pieces of tax law everybody needs to know about. Section 121 and Section 1031. Now, before we move on, I want to let you guys know that these 2 tax laws are not mutually exclusive. And what I mean by that is it is not necessary for you to have to pick one or the other. There are certain circumstances where you can use both of these tax laws together on the sale of one property. And Russ, this is going to answer your question, okay? So in a situation where you have a 2-unit building and you live in the top unit and you rent out the bottom unit, if you sell this property, you get to use both the 1031 exchange and the homeowner's exemption together. So you're going to take a 1031 exchange on the value of the bottom unit, all right? And you're going to take the homeowner's exemption on the value of the top unit. You're selling $1 million building. Half of the unit you live in, the other half you rent out. You get to take the homeowner's exemption and avoid taxes on the unit you live in, and you get to take a 1031 exchange on the unit that is being rented. This I see happen all the time. In places like Manhattan Beach, San Francisco, where there's a lot of urban 2, 3, 4 unit buildings, clients who own those might live in one unit and rent out the others. And if you're selling one of those properties, you want to advise your client to consider these two tax laws so that they can maximize their tax benefit. Now, it doesn't have to be a 2-unit building. We have clients who own different types of real estate that may qualify for both of these tax breaks. I'll give you an example. I had a client recently sell a farm. It was a 60-acre dairy farm. She lived on the farm, so the home that she lived in was eligible for the homeowner's exemption. The land that she had all of her dairy cows on was a business property. So she was able to do the 1031 exchange on the 60 acres, the value of the 60 acres, and she was able to take the homeowner's exemption on the value of her home. She walked away from the transaction. There's a $3.7 million transaction. She walked away from that transaction paying 0 in taxes. So understand how these two tax laws can affect your real estate transactions, and you can save your clients hundreds of thousands of dollars in potential tax liability. Now, Alan wants to know, what about a client that has a home and they rent out a room? Or maybe they have a cottage in the back. Well, that's fine. So you have a 1-bedroom here that you rent out to a person. Well, what you're going to do with your CPA is you're going to figure out the percentage of the total property that you're renting out, and then that percentage can be exchanged. All right, so I don't care what type of real estate it is or how many uses you have to it. I'm just going to be concerned for 1031 exchange purposes what the CPA is saying the percentage of the investment or business component is, and that is what is exchangeable. All right, so let's get into the nitty-gritty. You decide, well, geez, we do have a valid property for exchange. So how the heck do I do it? Well, we're going to go over the 4 basic guidelines for any successful exchange. Requirement number 1, make sure your properties qualify. In order for a property to qualify for an exchange, you got to make sure that it is used for business or investment purposes. Properties involved in an exchange also need to be like kind. And this can be a source of confusion. Some people think, well, geez, if I sell a 2-unit building, do I have to exchange into another 2-unit building? What if I want to buy a 10-unit building? Well, you can. We talked about this, right? Like kind is very broad. You can sell a 20-unit apartment building. You can exchange into land. You can sell the land and buy a rental home. You could sell the rental home and buy an office building. You have a lot of flexibility on the type of real estate you can get into. One thing you cannot do, though, is exchange property in the United States for property in another country. Foreign property is not like kind to domestic. So you sell in the United States, you need to buy in the United States. However, the United States is pretty big. You sell in California, you can buy in Texas. You sell in Texas, you can buy in Ohio. Go anywhere in the country. Now, One thing I do want to mention before we move on from this slide is I get a lot of calls from people doing flips. And they say, well, geez, my flip is an investment, so I should definitely be able to qualify for an exchange. Unfortunately, I have to tell flippers that the government considers quick flips inventory. And inventory is not exchangeable. It's actually specifically prohibited in the code section. So 1031 exchanges are only for investments. You cannot exchange inventory. And unfortunately, the government considers a flip inventory. Now, the government also considers development projects inventory. You buy a piece of land, you build a building on it, and then you sell it. Well, that was inventory, and that also is prohibited from being exchanged. So what we like to see is a holding period on your investment property of at least 1 to 2 years, so that when you are audited by the government, it is very clear that your exchange property was not inventory. So rule number 1, make sure your properties qualify. Rule number 2, when you do a 1031 exchange, if you do not want to pay taxes, I need you to remember 2 things. Number 1, reinvest all of your cash, and number 2, purchase property equal or greater in value. So I'm going to make this simple for you guys. People get confused on this all the time. I talked to a guy the other day. He was selling an $8 million property. And he said, well, geez, Leonard, I'm going to pay off a $4 million loan, so all I need to do is buy a $4 million property, right? Wrong. If you are going to sell an $8 million property, to defer all your taxes, you need to go out and buy another $8 million worth of real estate, and all of your cash that is generated from the sale is the down payment on the properties you're buying. No. But you don't understand. I have to loan on the property, so I got to pay that loan off, so I'm only going to get $4 million in cash, so I only want to buy $4 million in property. I don't care what you want to buy. I'm telling you what the government says you have to do in order to defer your taxes. If you sell for $8 million, you need to buy for $8 million or more. All of the cash generated from the sale is used as a down payment. Now, what that means is you're going to probably have to get a loan to replace the one that you had on the sale property. Now, you don't have to get a loan if you want to contribute additional cash. So you can always contribute additional cash, but most of my clients will replace the debt. So if you don't want to pay taxes, spend all your cash and buy enough real estate. So rule number 1, make sure your properties qualify. Rule number 2, buy enough real estate and spend all of your money. Rule number 3, when you are doing an exchange, you need to get it done on time. The government says that you have 180 days to complete your exchange. Your time frame starts the day you close escrow, and you need to go out and purchase replacement property on or before day 180. So you have 6 months, 180 days to purchase your replacement property. Plenty of time. The problem with the 1031 exchange, ladies and gentlemen, is generally not the 180-day requirement. Most people freak out because of what they have to do on day 45. Day 45, you need to submit your identification letter. Now, what does that mean? Well, that means you're going to have to submit in writing a list of all the properties you're thinking about buying. Remember, you sold a building, and you're going to complete the exchange by going out and buying something by day 180. Well, the government says, well, what the heck are you thinking about buying? And we want to know in writing by no later than midnight of your 45th day. So you give the government a list of 2,000 properties, and you say, well, I'll buy one of these. They crumple up that paper and they throw it back to you because they say, when you submit your list, Mr. Exchanger, you need to do so in accordance with either the 3-property rule or the 200% rule. Those are the only ways that you can identify and fill out your list for your identification. 3-property rule says you can nominate 1, 2, or 3 pieces of real estate. Day 45, you nominate your 3 top choices. You are then committed to buying something on that list. Very important, you cannot change your list after day 45. And the biggest question I get, especially in today's market, is, geez, Leonard, what happens on day 46 if this property gets sold to someone else? Can I replace it? No, you can't. You now have 2 properties left to exchange into. If you can't get either of those properties, you're out of luck. Well, geez, Leonard, on day 56, property number 2 actually burned to the ground. There's got to be some kind of break that I get. It wasn't my fault the property burned to the ground. Government doesn't care. You have 1 property left on your list. Go buy that one. The IRS is not very forgiving. Follow the rule, get the tax break. Don't follow the rules, don't get the tax break. So very, very importantly, if you're going to nominate on day 45 using the 3-property rule, you're going to submit a list of 1, 2, or 3 pieces of real estate, and then you're going to buy from that list. No substitutions or changes after day 45. You're sitting back in your chair thinking, well, this sucks. What if I want to buy 4 properties or 15 properties? Well, the government thought of that. And in the government's infinite wisdom, they came up with a really stupid rule. The rule is this. If you would like to nominate more than 3 properties, so in my example, we're going to nominate 5, all of the properties that you nominated cannot add up to more than 200% of what you sold. So if you sold a building for $1 million and you're going to nominate your replacement property using the 200% rule, you have $2 million worth of value that you can identify. So that could be 10 $200,000 properties. It could be 5 $400,000 properties. It can be any number of properties until you hit that $2 million limit, or 200%. Does that make sense? All right, of course, my company is going to be here for you step by step during the entire process, making sure you're nominating on time. We're going to bug you. We're going to send you email reminders a week before your day 45, on your day 45, and we're going to call you to make sure that you are following these rules. And there's 4 of them, remember? Number 1, make sure your properties qualify. Number 2, reinvest all your cash. Purchase property equal or greater in value. Number 3, get your exchange done on time. And number 4, what do you have to do on day 45? Nominate. All right, ladies and gentlemen, I've been talking a lot, and I usually have a little bit more time left to go over some stuff. But what I want to do is blow through these slides because these are not as pertinent as what is on this slide. This is the reverse exchange. And in today's market, I get a lot of people calling and saying, hey, Leonard, I want to buy my replacement property first. So instead of selling and then going out and buying something, what I want to do is simply the opposite. Buy first and then sell. Can I do that? Absolutely. That is called a reverse 1031 exchange. You're going to go out and you're going to acquire your replacement property, and then provided you sell within 180 days, this sale is going to be tax deferred. Well, geez, that sounds great. Why doesn't everyone do that? Well, number one, money. Okay, you haven't sold anything, so how do you go out and buy something unless you have a war chest of a bunch of cash underneath your pillow? So number one problem is money. Number two problem, money. All right, so the first problem is you don't have any money because you haven't sold anything, but let's say you do. Let's say you got 100 grand laying around that you can use. And you say, well, geez, that is certainly enough to for a down payment on this property that I want to buy. Well, the problem is you still are going to have to go get some more money in the form of a loan. And the bank that's loaning you the money to buy this replacement property is not going to be happy that it's part of a 1031 exchange. Most banks do not loan on reverse exchanges. And here's why. In a reverse exchange, you cannot own the new property and the old property at the same time. So in order to facilitate a reverse exchange, my company takes title to the new one. We become the owner of the new property. Now, we lease it right back to you, so you have all the burdens and benefits of the property, but we are the owner of record. Bank of America does not want to loan you $5 million on a property that my company is going to temporarily own. You tell Bank of America, well, geez, that's okay, because as soon as I sell this one, I will become the owner of the new one. Bank of America doesn't care. It doesn't fit in their box, so they don't loan on it. Now, there are some hard money lenders that will loan on reverse exchanges, and there's even one bank that is starting to loan on reverse exchanges for their biggest customers. But traditionally, lenders won't loan on these transactions. So the way to do a reverse exchange is to have a bunch of cash sitting in your bank account and to make an all-cash purchase on the replacement property. If you can do that, the reverse exchange is an option. We have about a dozen reverse exchanges going on right now. So there are people who do these things where they pay all cash for the property that they want to buy. They secure it. My company owns it temporarily. And as soon as they sell the down leg or the property they're trying to sell, we transfer the new one to them. Now, we do hundreds of regular exchanges every month. And right now I've got maybe a dozen reverse exchanges. So by and large, most exchange transactions are done the traditional way, where you sell and then purchase. About 5% of our deals, maybe even less, every month are reverses. So you might want to keep that in mind when you're chatting with your clients who say, hey, I heard about this reverse exchange. Don't waste your breath unless they can pay all cash or they're willing to go to a hard money lender, because it probably won't be an option for those clients. All right, ladies and gentlemen, it is 2 o'clock, and I always start on time and end on time, so we're going to end. What I want to do is just remind you that we do these webinars because we want to be your go-to 1031 exchange accommodator. I guarantee you that we will give your clients a very good impression. We know that we are a reflection of you if and when you refer us, so we work very, very hard to make you look good. I want to be your go-to source for all 1031 exchanges from here on out, so give me a call on your next transaction. You can also email me if you want to set something up. I will tell you real quickly, our fees are very, very competitive. We charge my mouse just froze. We charge $750 when you sell your real estate in an exchange and $200 when you buy. So our fee is $950 total on the sale of one and purchase of one. Now, I've had a couple people say to me recently, well, geez, Leonard, I looked on the internet and I found a company that's doing it for less. Well, I'll tell you what, all of the major established exchange companies charge about the same. So if you want to go and work with an internet company in Florida that's doing it for a lot less, beware. All right? That company in particular that I know of has been around for about 6 months. They probably have 2 exchanges in their track record, so you can definitely find it for cheaper. But when you're coming and dealing with hundreds of thousands of dollars in tax liability, the cheapest is not necessarily the right option. You want the best. All right? You're going to pay about the same when you work with all of the major institutional reputable companies. So don't go online and try to cheap out when it comes to this. You don't want a fly-by-night company doing your taxes, especially when you've got hundreds of thousands of dollars at stake. You want an established professional working with you. So that's what we are. We'd love to work with you on your next exchange. Now, I'm going to take a sip of water because I've been talking for 62 minutes straight, and I'm going to come back in 30 seconds and answer some of the questions that have popped up on my computer screen. All right, ladies and gentlemen, sorry about that. I took a drink of water and I went to hit the mute button and I hung up. So let's go over these questions here. Lan says, well, geez, I've got a room that I rent out in my house, and the room is 30% of the house. All right, so now you've got a 30% exchange. So Lan, if you sell that building for $1 million, you've got a $300,000 1031 exchange. Leanna has a long question, and I was avoiding it because it was hard to read, but I'm going to read it now. Leanna, if someone bought a property for $570 and sold it for $745 and bought another property for $745, is he going to have a tax liability? Absolutely. So he bought for he sold for $570, bought for $745. Now he's selling again for $745, so this second property is making no money. He's breaking even, but remember, he exchanged into it, and he had deferred gain from the previous transaction. That gain, if he cashes out, is going to be taxable. Lan says, if I put in $400,000 first to close the replacement property, and I get a loan after the transaction closed, when I sell the acquired property in the future, do I have to put $400K in to cover the loan? Yes, you do. So you're going to put in your own $400K, you're going to pull it out later, you're going to sell the building, and you still need to cover the full value of the property. So you have less equity, so now you're going to have to buy property, getting a loan, or contributing additional cash. Peter says, what franchise tax board form do you use if you exchange out of state? Good question. So there is a new requirement. If you sell a California property and you 1031 exchange out of state, the state franchise tax board makes you file an informational return every year you own that out-of-state property. Peter, I don't know the actual number of the form, but you can Google it. Can I use 1031 exchange dollars to pay your fee? What about the loan fee? I want to avoid out-of-pocket expenses. Steve, very good question. There are certain fees that you can pay with your 1031 exchange dollars, and those are any non-recurring closing costs. All right? Has to be a non-recurring closing cost, and it cannot be related to the loan. So what fees qualify as deductible expenses in an exchange? I'll tell you. Commission, title and escrow, transfer tax, 1031 exchange dollars. Okay, those are the big ones. What fees do not and cannot be paid with 1031 exchange tax-free dollars? Loan fees, property taxes, HOA expenses, any recurring fees or any fees related to the loan. And Leanna wants to follow up. What if I sell for $570? No liability. That is correct. Connie says they sold without any plan for a 1031 exchange. And if it is qualified for an exchange, can they start exercise within 45 days? No. Connie, if you sold and you did not set up an exchange account, you are a taxpayer. You absolutely need to set up your exchange before you sell the property. So how do you do that? Connie, give me a call. If you're in escrow and you close tomorrow, I can set up the exchange account today. If you closed escrow yesterday, you're out of luck. Ladies and gentlemen, fantastic webinar. I always love it when I get a lot of questions, which I did today. Have a fantastic day. If you have any follow-up questions, shoot me an email. Love to help out. Love to do business with you in the future and look forward to it. Have a great afternoon, everybody, and hopefully we'll hear from you soon. Take care.